Good morning, everyone, and thank you for joining us for CBM's Year-End Tax Planning and Market Update webinar. This 75-minute session is being hosted by CBM and MBI, the firm's financial advisory subsidiary, and our presenters today are Richard Morris, Alex Seleznev, and Janice Wofford. Representing our individual and business tax practice, our financial planning and wealth management practice, and our outsourced practice, which consults with businesses on year-end tax and business operations planning. Our professionals will be available for complimentary consultations following this webinar. I'll share a little more about that at the end of this session. And now I'm going to ask Alex to please share the learning objective slide. Thank you, Alex. Looks like you beat me to the punch for today's session while I read our presenters' bios. Richard Morris is the Director of Tax Services at CBM. He has more than 35 years of public accounting experience and works with closely held businesses, their owners, and executives. He also has extensive experience in estate, trust, corporate, individual, and partnership taxation, and specializes in working with clients with unusual or complex tax circumstances. He has been a regular speaker during CBM's webinars in recent years, helping businesses and individuals navigate federal relief legislation related to the pandemic, and he was recently quoted twice by the Washington Business Journal on Paycheck Protection Program loan forgiveness. Alex Seleznev is a partner and portfolio strategist at CBM, as well as co-founder of MBI. He is a certified financial planner and a chartered financial analyst who leads the firm's investment management division, and he enjoys creating comprehensive financial plans to help clients reach their short and long-term financial goals. He presents regularly for CBM at the firm's quarterly market update sessions and on a wealth of other topics, including financial strategies for mid-career professionals, retirement planning, Social Security, 529 education plans, Medicare, and long-term care insurance. Janice Wofford is a senior in charge with CBM's outsourced accounting practice group. She has more than 10 years of accounting experience providing business clients with customized solutions to meet their tax, accounting, and business operations needs. She will be speaking on effective strategies for businesses to close the year with a clear understanding of their tax liabilities, as well as on how businesses can take advantage of workflow efficiencies through the use of technology. Questions submitted during registration have been given to our presenters, but any other questions that come up today during the session should be entered into the chat box. CBM has budgeted an additional 15 minutes today to give us time to answer your questions. This session is being recorded, and a copy of the slides will be distributed to all participating attendees. Finally, to wrap up, participants interested in receiving CPE should respond to 4 of the 5 polls that will be launched during today's webinar. I'll announce each poll. Depending on your device, the polls may appear on the meeting screen or in the chat box. Please only respond to a poll in one location. And let me just quickly launch a quick poll. You don't need to respond to this. Again, this is a poll that will appear in the meeting screen or in the chat box. And so that's pretty much it. With that, I'm going to turn this over to Alex.
Well, thank you, Joe. And thank you, everyone, for joining us today on this, I would actually say, beautiful day here in Maryland, especially for December 7th. So as always, with our year-end webinars, we'll start with the market update. And then, as Joe mentioned, we'll talk about different tax strategies and considerations. So overall, well, it's been a good year so far. I would actually say it was a pretty good year for the vast majority of asset classes, with the exclusion of some, and we'll certainly cover them in detail today. Usually what we do in our quarterly or year-end market updates, we try to figure out what's been the theme for the recent market, I guess I'll say situation. So as you know, many of you know, it's been really all about the supply chain or supply chain issues, to be specific, and of course the chip shortages, or the whole issue with the semiconductor industry is on well, everyone's mind, especially in the investment industry. Of course, inflation is a big issue, and we'll have a dedicated section of the webinar. We dedicated a section of the webinar to that. So with that, let's get started. So in terms of the market conditions, again, it's been a pretty good year so far. Domestic large cap stocks, as measured by the S&P 500 index, are actually up by more than 22%. At this point, the data on your screen is as of November 30th. Domestic small cap stocks are up only 12% for the year. And what's interesting about small caps, they're the first major index that actually experienced a true market correction over the past 40 to 50 days, a little more than a month, I guess, at this point. That index was down by more than 10%. So that's considered to be a correction. Developed international markets, so European, Japanese, Australian markets are up only says 6 to 7% for the year. I'll tell you they've been somewhat sluggish over the past 7 to 8 months. They actually started the year pretty well. They were up 8 to 9%, but then actually gradually declined. I would say mostly due to COVID issues, which we'll also talk about today. Now, emerging international markets are in the negative by 5%. Now, that is actually a very diverse group. It consists of different countries, of course, and the economies of those countries are very different. I would say they're somewhat similar if you look at the developed world. So to be more specific, Chinese stocks, which usually represent 30 to 40% of a typical index or mutual fund or any other kind of fund, are down by more than 20% for the year. And as a result of that, they essentially drag the entire index in the negative territory throughout the year. In terms of domestic bonds, well, they've been in the negative throughout the year, actually improved a little bit over the past couple of months, and this is as measured by the Barclays Aggregate Bond Index. Bonds are down by 1.4% for the year. There's actually a pretty wide range depending on the quality and duration or maturities of those bonds, but overall it's a negative 1.4%. In terms of the sector performance, well, energy and real estate continue to dominate. I mean, there's no other way of saying that. Energy is up 42%, real estate or real estate investment trusts are up 28%. And I'll mention that both of them were actually in the bottom in terms of the sector performance in 2020. So that's quite a rebound. In terms of the laggards, well, consumer staples and utilities. They're not in the negative, but they're up again only 4 to 5% for the year. But no sector is in the negative, at least as we speak today. Now, in terms of our market outlook, well, as perhaps many of you noticed, we experienced some volatility that actually started on Black Friday when we had a short market session, and we happen to expect more volatility going forward. There are multiple reasons behind that, and this is just perhaps a short list of those reasons. Well, I'll start with a statistical one. We are expecting to have at least 1 or 2 corrections each year. Again, a correction is when any major market or major index is down by 10% or more. We haven't had one since April of last year, so 20 months of no corrections. Now, corrections are healthy. They remind people about the benefits of a disciplined approach to, in this case, investment management. And they also remind people that stocks do not only go up. And every so often, we get surprised, but, investors, I'd say as a group, tend to forget that. So again, corrections are healthy. Now, in terms of the sentiment, if you look at the stocks that have been leading the market, and we'll talk about that, we have a separate slide, you would notice that the overall sentiment remains quite bullish. Again, perhaps not as much as it was throughout the summer, but most people, most analysts are expecting the markets, again, to continue to go up. In terms of the economic growth, well, perhaps we experienced this so-called peak growth in the second and third quarters of the year. Now, I will say there's not necessarily a perfect correlation between stock prices and economic growth, but there's certainly some correlation in terms of expectations, especially. So we're certainly expecting less growth next year, and perhaps that would be reflected in equity prices. Now, perhaps the biggest elephant in the room at this point that again appeared on Black Friday is the new variant of coronavirus, well, the Omicron, and I hope I'm pronouncing it correctly. I'll just say a lot is unknown at this point. I've been reading about this essentially daily. What appears to be known is that it spreads quicker so it's quite contagious compared to the Delta variant. It is not clear how deadly it is at this point. And of course, as many of you know, the Delta variant is quite deadly. Now, in terms of the vaccines, well, of course, every major producer, already gave some kind of interview to give their point of view. We're trying to figure out if the existing vaccines would be effective or not. And if they are effective, then of course, how effective. In terms of the new vaccine production, what I hear is that if that's actually needed, and most likely it will be, of course, needed, it would take 3 to 4 months to actually develop them for the new variant. But of course, perhaps there are other updates that just came out, so we'll be keeping track of that. In terms of the U.S. corporate earnings, well, they were predominantly positive for the third quarter of the year, but also at the same time, many, perhaps even most companies, lowered their expectations for the fourth quarter. And in terms of the mostly quoted reasons, well, supply chain issues, labor force participation, wage pressure, and of course, increased cost of inputs for, producers were some of the main reasons. In some sense, no surprises there. In terms of the annual S&P return estimates, and for those of you who know me personally, I try to really stay away from those types of prognostications. But in terms of the analysts' expectations, somewhere between 7 to 12% for next year. Now, that is still significant. That's still pretty good, but that compares to low teens to low 20s, which was the expectation at the time for 2021. So again, the expectations are essentially going down at this point. Now, in terms of the economic conditions, again, we expect the economic recovery to continue in the first half of 2022, but again, at a slower pace. Based on the data we have, it's becoming more and more clear to us that we already reached this mid-cycle phase of a typical business cycle, and usually that's the longest phase, and it comes with moderate levels of growth. One of the considerations here is the recent updates to the monetary policy. Perhaps as some or many of you know, the Fed decided to reduce their monthly bond purchases by $15 billion with the goal of reducing the liquidity. And there's a good probability at this point, assuming things continue as is, that interest rates will begin to go up as early as mid-2022, perhaps even earlier, again, depending on what happens with inflation. At this point, we're expecting 1 or 2 rate hikes, 0.25% each, but perhaps we'll see more, again, depending on what happens with the economy. In terms of the growth projections, this is the IMF numbers, 6% for the US for the full calendar year of 2021, and then a gradual decline of 5 to 5.2% for the next year. You can see what it is for developed and emerging markets. What was interesting to me when I was preparing for this webinar is that for China, which is the second largest economy, the growth for this year is expected to be at 8%, which is pretty good. For next year, it's only 5.6. And if you compare that to what they're expecting for the US, well, it's almost identical, right? And for China, that is actually not that great. I even heard some economists saying that, if they continue with their existing policies, which is quite something. We'll talk about that separately. Perhaps they'll even experience negative growth at some point in the future. In terms of inflation, well, as measured by CPI at least, it's at 6.2%. That's the official number. I'm inclined to say that the unofficial number is much higher than that, especially if you include the real housing costs. And for those of you who are perhaps less aware, when you look at CPI, it only includes this convoluted formula for how much an average person is supposed to be paying for rent. But for many people who are trying to actually buy a house, chances are the real CPI would be much higher than that. And of course, that compares to 1.7, which is where we were in the beginning of this year. Unemployment rates, well, they gradually continue to go down, and I would say overall that's certainly a good thing. We started the year at 6.7. The latest read is at 4.2. With unemployment rates, I always take them with a grain of salt. There's lots of statistics behind them, and one of them is that since the pandemic started, more than 5 million people actually exited the labor force. I'm not talking about those who decided to open their businesses or they're self-employed. They actually exited the labor force. Many of them are actually over the age of 55. So think of them as early retirements. So that's one of the reasons why the number is going down. But overall, certainly we would prefer that it continues to go down and not up. Now, in terms of business cycle updates, there's a lot of information behind this chart, which we'll not go into, but very briefly, a typical business cycle consists of 4 phases, usually last 3 to 7 years. You have the early expansion, you have the mid stage, which is perhaps where we are at this point. Then you have the late cycle expansion, and then of course there is a recession. And each of those stages can last for a different period of time. Now, if you look at it, and this data is from Fidelity, notice that they're actually expecting that China will very soon experience a contraction. This is interesting. If that's the case, then perhaps this should really inform your investment decisions. And in general, by the way, one of the reasons why we pay attention to something like this, different types of investments tend to perform quite differently in different economic cycles. That's why, again, this is something to keep an eye on.
Okay, now, excuse me a moment, Alex. I'm going to launch the first poll now. Please respond to the poll on the meeting screen or in the chat box if you're interested in CPE. Access the chat box by clicking the bubble image at the top of the screen. Thank you.
Thank you, Joe. So the next chart is actually one of my favorites. This is the asset class returns quilt. And essentially what it shows you the performance of each major asset class year by year, so from 2011 all the way to year to date. And then we summarize it for you on the very right. We're giving you the average return. So there are, I'll say, 3 things to point out. One of them is that if you look at the chart, if you study it, you would notice that emerging markets specifically, and I would say to a lesser degree, small cap stocks tend to perform very differently in each calendar year. In this particular case, they tend to be much more volatile and unpredictable. And if you decide to invest in those types of companies or in those regions, chances are you would need to manage your portfolio more actively. To say this differently, those types of investments are not necessarily a good choice for buy and forget strategies. So that's usually how we would approach this. Notice that commodities, which, as I mentioned earlier, as a group, this is a basket of 10 major commodities. They're performing really well this year. They're up 21%. Certain commodities are even higher than that. Notice that in prior years, in most of the prior years, they're actually at the very bottom. Now, gold, we tend to talk about gold quite frequently. It's in the positive in most of those years, but commodities as a group have not been performing that well up until, again, 2021. And then finally, perhaps the most important point, if you look at the bond or fixed income performance over the past 10 years, and if you look at the average return over the past, 10 and a half years of 3.2%, well, that happened when interest rates gradually went down from 5% in 2011 all the way to 0, which is where we are now. Now, what do we expect to happen going forward? Do we expect interest rates to continue to go down, which I guess is possible, but not very probable? Or do we expect them to begin to go up as early as next year? So it's most likely the second option. And in that scenario, those who have significant allocations to bonds, I would say most categories, would most likely see those bond prices go down, at least temporarily. So that is something also to keep an eye on. In terms of the domestic stocks, the style performance, something that we pay close attention to when we rebalance our portfolios. So in the first part of the year was all about mid and small cap value stocks. Perhaps some of you remember the so-called rotation from growth to value. And when I say value, just so you know, I'm talking about manufacturing, I'm talking about banking, financial companies, resource management companies. So not necessarily just oil and gas, variety of different things. Retail is actually on that end. In the second part of the year, since this summer, we started noticing a transition back into growth, specifically large cap growth stocks. So as we speak today, the growth category actually significantly outperformed other classes for the year. Perhaps it will shift, but again, it's interesting to see how things change over time, especially when you rebalance your portfolio. Now, inflation. So this is a biggie. We certainly wanted to discuss this today. So I will start by saying that finally, Mr. Powell came out, the Fed chairman came out a couple of weeks ago and said that we should no longer use the word transitory when we communicate with the public. So finally, he admitted that perhaps this is more of a persistent issue. That is the case from our perspective. Again, to sum this up, there are global supply chain issues. We're not just talking about, here in the US, many other countries are experiencing the same issues. Of course, you have those temporary and perhaps more importantly, permanent shifts in demand. We're not talking about just a pent up in demand when someone didn't travel all that much in 2020 and wants to take more trips, to Hawaii in 2021. So there's a lot of people trying to chase the same goods or services. We're talking about a permanent shift. A good example of that is when companies are transitioning into the cloud. And this is not just in the US. Every company in the world is essentially trying to do the same thing. So back to the very first slide with the chip shortages, well, almost every country is experiencing that. Will those issues be, satisfied? Will that demand be satisfied? Well, sure. Not likely in the short run. It will likely take some time. And then, of course, in terms of the labor force participation, which has been improving, and specifically wage pressure, well, those things tend to be sticky. I used an example in the previous webinar, but I'll just say, if you started paying someone $25 per hour versus 20, it's going to be very challenging to change that in the future. And anyone else who enters the same industry would most likely ask for more or less the same wage. So those things tend to be sticky. Now, what are some of the considerations from, I would say, more of an investment perspective? Well, with everything I just said, history tells us that high inflation is actually not very common for mature developed economies. It certainly happens, but it usually doesn't last all that long. Usually the growth rates are not all that high. Developed economies, they tend to use a lot of technology to produce, their goods and services, and technology tends to be deflationary overall. It doesn't actually increase inflation. Of course, other factors as well. Now, the impact of the Fed's decision to increase interest rates, perhaps as early as next year. Well, that would be one of the main objectives, right? To fight inflation, and perhaps they will be successful. So we'll wait and see. In terms of the companies that we currently favor, are those that have the ability to pass their increased costs to the end consumers. So you're looking for, well, I'll call them quasi-monopolies, those that have very strong positions in their respective markets, and they can again pass their additional costs to the end consumers and essentially keep their earnings at the same level. In terms of our ideas, and just so you know, of course, I have to keep it general. We cannot provide any specific advice in this webinar, but for bonds, we really try to stick to short maturities, high quality. We really don't want to take any additional risks at this point, and that's been the case for a while now. With stocks, one of the best ideas we have are companies that pay dividends, but also have a history of increasing those dividends. And that's very important, not just those that pay a lot, but those that have a history of increasing those dividends. To us, that means that they're strong to begin with. And the fact that, again, that they can increase those dividends tells us that perhaps they have more of an ability to pass their increased costs to their end consumers. There are other options as well for those of you who are interested. There are REITs, but you have to be very selective. If you decide to deal with REITs, there's preferred stock. By the way, convertible bonds, they're not on the list, and also total return bond funds. So there are other options if you're interested. Now, I'm not going to spend much time on this particular slide. I'll just say that Goldman Sachs, actually, they performed this great analysis. They looked at a lot of data, and essentially they determined that stocks in general, or domestic stocks in this case, tend to provide a good hedge against inflation when it's low, moderate, and high. Now, if we experience any kind of hyperinflation scenario, then actually gold tends to perform better. But in many other scenarios, you're actually better off sticking with stocks. So just wanted to mention that. So to sum this up, again, as part of our year-end planning, well, this is, again, a great time to review your investment strategy. Make sure that you adjust, again, your strategy and your underlying holdings for the current market conditions, and make sure that, of course, it matches your plan. There are two examples specifically. If the last time you looked at your portfolio in mid-2020, or maybe at the end of 2020, this would be a good time to review, because things changed, I'm going to say, dramatically over the past year. So in terms of the asset class performance and in terms of where we are. If you have a heavy allocation to bonds, please, revisit that. Make sure that you're, projecting, your long-term returns adequately. Now, if we experience more market volatility, be prepared to take advantage of it. Potentially rebalance your portfolio, right? Just like you would normally do periodically. Potentially reduce your allocation to bonds and buy stocks at lower prices, especially if you're concerned with inflation and you're looking for more income, meaning instead of generating interest, your portfolio would be generating more dividend income. Adjust your equity allocation, which is what I discussed earlier. Not every style performed the same way, and there's certainly pockets at this point that perform significantly better than other styles. In terms of the mid-cycle investment ideas, we actually already adjusted most of our portfolios. We reduced the allocations to mid and small cap stocks. They tend to perform well when the economy is expanding rapidly, and we really favor large cap stocks or funds that have a history of dividends, those that have the ability to control their destiny. We already talked about the inflation protection ideas, so consider that as well. Overall, again, revisit your plan and be prepared. And with that, Richard, what do you have for us?
Thank you, Alex. It seems that the market has been both interesting and volatile the last number of years. My name is Richard Morris. I'm the Director of Taxes at CBM. Thank you for joining us today. We have a lot. If you look at the slide deck, there's a lot in there. Some of them are going to go faster than others, just to make sure in the interest of time we get through them, but always put your questions in the chat if you have them. All right, as we wrap up 2021, it's important to take a closer look at your tax and financial plans. This year likely brought challenges and disruptions that significantly impacted your personal and financial situations. Continued global pandemic, several significant natural disasters, tax laws, political shifts. So, let me jump back one slide here as we go back. So we need to look at some things maybe we didn't before. There's a new round of what are called EIPs, economic impact payments, and those came out of the act that was passed back in last March. And what they did is they basically, it was to get cash. A lot of these acts, the idea was to get as much cash into people's hands as quickly as possible. If you keep that concept in mind, I'm going to change these things one last time and go back to it. If you can keep that concept in mind, that's the constant in a lot of these things. there were changes to the child tax credit, which is people who heretofore didn't qualify for the child tax credit were getting child tax credits. And even to the point where you're getting half of them deposited in your bank accounts last summer. I mean, that is a seismic change. Individuals who don't itemize their deductions, and we'll talk in a little bit about how the changes in standard deductions compare there, but you can still deduct up to $300 of qualified cash donations or $600 on a joint filer. RMDs, required minimum distributions. If you're age 72 by the end of this year, which I think means you were born in 49 or earlier, you're required to take certain amounts out of your retirement accounts, okay? That used to be 70.5, one of the odder things in the tax law, but they changed to an even 72. So that can cause some additional complications, especially in the first year you have to do it. And then unemployment. 2020 saw a lot of people getting receiving unemployment compensation for the first time ever because of the pandemic. And so in 2020, they made a specific exclusion that said the first $10,200 of unemployment that you receive, unemployment compensation you receive, wasn't taxable. But normally unemployment was taxable, and people say, well, that doesn't seem fair. Sometimes it's not about fairness. It is the idea unemployment replaces your income. So if your income would have been taxable, then the dollars that are given to you to cover for that lack would then be taxable to you. So now's the time of year to take a look at where you stand. When we completed last year's returns, a lot of people got an unwelcome surprise in the form of a reduced refund or possibly had taxes due at the end of the year. And several factors may have caused that, but often it was the changes due to the pandemic. The withholding tables changed, and so now is the time to look at it. And it's not too late. It's never too late. If you change your withholding in December, it's treated as if you had it made ratably through the year. So the easy example is, let's say you have $12,000 withheld in December. It's treated as if you had $1,000 January, February, March, April, May. So if you're in a position to affect your December payroll withholding, there's still time to do it and clean up some past sins and avoid penalties is a big thing for us. Individual income tax brackets. The big news here: the rates didn't go up. Okay, we all know what all went on this summer. What is still going on? They didn't go up. An interesting note on this is in 2018, which is the last year that there's data. The average federal income tax payment was $15,322, which puts you in this AGI bracket of 50 to 75,000. So that would be in this 22% bracket. So what does that mean? That doesn't really mean anything to us. So if we look by comparison, the median household income in the District of Columbia in 2018, the most recent year there's data, was $85,200. That is number one in the nation. $85,000 median household income in DC. State of Maryland was number 2 at $83,242. Virginia was 11th, and West Virginia was last at $44,000. Dividends and capital gains rates. Again, sort of the dog that didn't bark. There's some minor inflationary adjustments here, but these rates didn't change. So what is this table telling us? This table is telling us if we're a single filer and we have long-term capital gains, which means you held it over a year, or qualified dividends, which most of your dividends are if they're in U.S. companies, and it'll say in the little statement you get at the end of the year. If your income was up to $40,400, including your long-term capital gains, qualified dividends, you paid no tax on those capital gains, okay? And then you can just follow the table across with joint filing separately, because the way it works for capital gains is there is a preferred rate. So it means you can be taxed at no more than 15%. So let's say you're in one of those earlier brackets. Let's say you're in let's go back. So let's say you're in a 12% bracket. Your capital gains are taxed at the lower of your ordinary rate or the capital gains rate. So this 15% rate doesn't kick in until you're in that bracket. So that's what that slide is showing us there.
Okay, excuse me a moment, Richard. I'm going to launch the second poll. If you're interested
Sure.
in CPE, please reply to the poll on the meeting screen or in the chat box. I'll have the poll open for another 20 seconds or so.
Okay, standard deductions. Again, minor inflationary adjustments to that from last year, and you can see on the table where you stand based on your filing status. So that's inflation was low last year, next year to be determined at that point. State and local tax issues. SALT. This is an acronym for state and local taxes that most people hadn't heard of 5 years ago. And where did this come about? In exchange for the doubling of the standard deduction. So for a married couple, it went to $24,000 from 12. So in exchange for that doubling, the give back, the pay for in the term, was to limit the state and local tax deduction to $10,000. And so state and local taxes, what the heck are state and local taxes? They're your income taxes. So if you're a Maryland resident, they're your Maryland income taxes. If you're Virginia, your Virginia income taxes, DC. But then they're also your state real estate taxes. Okay, those get jumbled together. And so that's a pretty severe curtailment along the East Coast and along the West Coast. People in the middle, not so much. New Jersey has the highest real estate tax rates in the nation. The average New Jerseyan, and averages really don't mean a lot, but is $8,000. So we're all the way they're up against it. Marylanders were hard hit because Maryland is no slouch in the state and local tax department either. And when this passed, Maryland had the highest percentage of people who itemized on their returns anyway. So you've heard the term SALT a lot. So some of the states had what they called a workaround, which was just like your employer can withhold your income taxes, your business could withhold and pay Maryland your income taxes, and you'd get a deduction to it. That was a workaround. Sort of cumbersome in the sense that it took Maryland until July of this year to get it straight for last year. And there's still some issues there. So the other state and local issue is the pandemic. Okay, and people have changed where they live and work. They've gone to second homes, they've moved out, they've moved back with mom and dad, they've done whatever. And that can give rise to, I use a Latin term, nexus, location. So that can give exposure to state tax. And some states are more aggressive than going after their people who moved out. So we'll take New York, high tax state, a lot of people moved out. Florida, Maine, wherever. Well, New York's very aggressive in going after those people who abandon their state. So the takeaway, watch your days, watch your activities. A lot of people go, I was just out of there 183 days. Well, it's not that simple in the digital age. So it's something to keep track of and be aware of. Crypto, virtual currencies. These are common. Watch your exposure. If you were following any of the bill discussions that were going on, Build Back Better and the like, it was how do we tax these things? How do we get reporting? If I'm a business owner and somebody gives me $10,000 in cash, I have to file with the IRS. If I'm Domino's and somebody gives me some Bitcoin for their pizza, I don't have to report that. So there's different reporting rules there. So there is a question on every tax return that says, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in a virtual currency? You can't blow that question off. You got to answer it honestly. You got to report what's going on there. And there are different types of virtual currencies. I mean, you've got your Bitcoin, Ethereum, non-fungible tokens. Again, NFT, a term nobody had heard of before about the last year or so. So, those can give rise to taxable events there. Another acronym we're going to use. We're heavy on the acronyms. The net investment income tax, the NIT. What is it? This has been around as part of the ACA Act of 2013. So this is part of how they pay for the Affordable Care Act, which is an additional tax. You figure out your regular tax, your AMT, payroll tax, and then on top of that, you got to pay an additional 3.8% tax on the items of income that are listed there. What's the threshold? It's $200,000 for a single filer, and it's $250,000 for a joint. So, and it's only on those types of income. So if you have, well, you just say joint filers, $250,000 of wages and $100,000 of long-term capital gains, your total taxable income is $350,000. But then on that $100,000, there's an additional 3.8 that is added on top of that. Okay, it's interest, dividends, long-term capital gains, and also rental income if that's considered passive. Okay, so in other words, if I'm not in the business of renting real estate, if you have a beach house or something you're renting out, that's considered passive, as opposed to someone who's in the trade or business of renting real estate. So that's something that is not new, but those amounts, 250 and 200, have not been indexed for inflation. The alternative minimum tax has been around since the Great Society, and the idea of the alternative minimum tax is to make sure that everyone pays what it says, a minimum level of tax, despite using various exclusions, deductions, and credits to reduce your regular tax. Some of the things that were part of the AMT, because basically it's a parallel structure. You figure out your regular tax, and then the law says, all right, that's great, but now you don't get certain deductions. So you don't get state and local taxes, for example. You don't get miscellaneous itemized deductions in computing the AMT. So now you already know that, well, some of those things went away or they're severely curtailed. So there are fewer people that exposed to the AMT as before. But a big one is incentive stock options, okay? And so the exercise of incentive stock options, which are still a vital piece of a lot of people's compensation, is an alternative minimum tax adjustment that you make. So, it didn't go away. It's just they've raised the limits to it, the minimum where people are subject to it. And then they've eliminated a lot of things that would get added back for AMT. So the dirty little secret of this SALT tax limitation or SALT tax deduction limitation discussion is that people weren't getting that benefit before. If they were really high income people, they weren't getting that benefit. So when you hear about it going to 80,000 or 100,000 or whatever the number is, they were having to add that back for AMT. So they might have looked sort of superficially at their return and said, well, I'm getting this deduction on Schedule A, but not realizing that they were giving it back on the backside for the AMT. So it is complicated discussion, complicated calculation. So it's something you want to be working with your CPA on that, because it didn't go away. It's just sort of in hibernation for a lot of people. Why do we work? We work so we can retire. And so the 2021 limits are on the screen. 19,500 for 401k, 403b, 457. And then you get this additional catch up if you're age 50 or over. Just like for an IRA, you get an additional $1,000 if you're 50 or over. Well, that 19.5 goes to 20,500 for next year. So it gets a $1,000 bump. Roth IRAs, the difference with a Roth between a regular is you don't get a deduction when you contribute to a Roth like you do for a regular IRA. It grows tax-free like in an IRA, but you can withdraw the funds tax-free when you reach the certain age at that point. So there's a planning opportunity there, and you can convert to a Roth. So you can convert a regular IRA to a Roth. You pay tax on all the growth, but then from that point forward. So that's a planning opportunity, especially if, heaven forbid, you had a down year or something like that. There are cases where it makes good tax and financial sense to convert to a Roth, to convert a regular IRA to a Roth. And then the self-employment plan IRAs, that's based on self-employment income. Estate and gift tax. The American Taxpayer Relief Act raised this year, years ago, to 11.7 million. So if you look at it and you go, well, I don't have 11.7, I'm in the clear. Not necessarily. For one thing, that is scheduled to sunset in a mere 48 months from now. Okay, that always had a sunset in it. A lot of these laws, these tax laws, have a sunset period because of reconciliation and all the gymnastics that you see they're trying to go through on Capitol Hill. Nothing's permanent. So this is scheduled to sunset, is the term, go away in 2025. So where does it go? It goes back to where it was in 2016, which was 5.5 million in change. And so it would be adjusted for inflation if nothing happens. If they don't even touch it, it's still going to go away. Also, many states have lower limits, which we'll talk about in a minute. So again, just because you look at the big number and go, well, that's not me. But also, it's not just the transfer of those assets. It's where the things go, and you have to look at your year, and if you had some of the big life events, birth, death, divorce, promotion with a big raise, it's time to look at your documents and see, like things going where you want to go. There's some privacy issues, some asset protection from, creditors or, aberrant family members and things like that. So what is the state impact on this? Remember, right now, today, as we sit here, the feds are at 11.7. And we see that Maryland's is at $5 million. Okay, it's not currently scheduled to change. So Maryland has no automatic inflation adjustment in theirs. There are no bills for it to go up or down at this point, but that's where it is. And it is portable, which means it goes, if it's not used, it goes to one surviving spouse if they're married at the time. Maryland does have an inheritance tax. Maryland is one of only 7 states with an inheritance tax. And that is if you leave something to a non-spouse or lineal dependent. So you can leave them to your spouse or your children. There's no inheritance tax. You leave it to your good old neighbor, Bob, inheritance tax on that, in addition to all the other tax that you pay. Their exclusions is scheduled to rise for an inflation adjustment for next year. That number has not yet been released. Virginia repealed it years ago. There was a brief attempt in 2020 to reinstate it. That got defeated. The takeaway from this is residency matters. Residency matters. Education. This is sort of a complex miasma of stuff in there. So the American Opportunity Tax Credit, and this goes back years, it's just that, a credit. And credits are more valuable than deductions because a credit is a dollar for dollar reduction of your tax liability, whereas a deduction is a reduction of your taxable income, which then is taxed. So one is dollar for dollar, one is a percentage. So if, would I rather have a $1,000 credit or a $1,000 deduction? I'd rather have a $1,000 credit because the deduction is only worth, the sort of the inverse of my tax percentage rate. So that's where the credits come in, and you can get those refunded even if you have no other liability. There are some pretty severe income limitations. Excuse me. American Opportunity, it starts phasing out at $80,000 for a single, and it's phased out by 90 for joint. It starts phasing out at 160. So pretty low. Lifetime Learning, which is up to $2,000 annual, that's even lower. That starts phasing out at $59,000. So we can go through all those points if that's an issue for somebody. 529 plans. The great thing about 529 plans, yes, it allows you to put away money for it to grow tax-free and be distributed tax-free as long as it's used for future education costs, college and university. And now there was exception that came out last year, which is you can take up to $10,000 per beneficiary, not per account. You can't put up 20 accounts for a grandchild, but per beneficiary for elementary and secondary school, so grade school and high school in regular English, whether they're private, religious, charter, whatever. So again, the idea is it spreads the utility of them. You can use them not just for college anymore, but for grade school and for high school as well. And really, they are the best tool for grandparents who want to provide something that's important to them, to their grandchildren, with some restrictions on it so that it's not, it's not sort of willy-nilly.
Okay, excuse me a moment, Richard. I'm just going to launch the third poll here. Again, this will appear on the meeting screen or in the chat box. So please take a moment now to respond to the poll. If you need CPE, I'll close this in about 20 seconds.
Okay. Showing on mine, wasn't sure if it was showing on everybody's at that point.
You're free to proceed.
All right, charitable contributions. With this increase in the standard deduction, a lot of people thought, okay, I'm losing my charitable contributions. As we stated earlier, even if you're not itemizing, you can still take up to $600 on a joint return for qualified charitable contributions. So cash money to established charities. But even if you don't itemize, you can still sort of bunch your deductions and sort of say, okay, well, every other year. So instead of making my deductions in 21, I'm going to hold off and I'm going to double them up in 22 as a way to get the benefit of it. So you're always going to get 24,000. Let's say your joint. It makes the math easier. Or it's going to be 25,000 this year. But if you're sort of close, then you can. There are times you can sort of bundle them up into alternating years or every third year or something like that to be able to get the deduction, because you're always going to get the minimum anyway, as a even if you don't itemize. And then there's also something called a donor advised fund, a DAF. And what that is basically you can take a big charitable contribution in 1 year. So you sort of create this pot of money. You get the deduction this year. And then that fund can dole those out to again, it's supposed to be qualified charities in future years. So you don't have to decide all in 21 where this money is going to go. But at least you can get the deduction. The money sits in this pot, it grows tax-free, and then can be distributed out to other charities, or to charities at that point in subsequent years. No, you don't get a double deduction. Even if it increases, that's sort of the risk that you take, or if it goes down for that matter. But some things haven't changed, which is you need to have contemporaneous record keeping of your charitable contributions. What does contemporaneous mean? It means you need to have a letter from the charity by the time you file your return, okay? A letter of acknowledgement, and usually it's on the letterhead, and it'll say, thank you for your gift of such and such on such and such a date. Or if there's stuff, it would say the value of the stuff. So if you get a meal, a CD, a ticket to something, a dinner, thank you for your contribution, of $1,000 to the Human Fund on this date. The value of your dinner was $250. Therefore your charitable deduction is $750 or whatever it would be. We still get a lot of questions on clothing and household items, and the condition they need to be is good used, or good used condition or better. Okay, and in a lot of ways, what you paid for it originally is pretty irrelevant. Okay, I might have the $1,000 suit, but if you look in the Salvation Army or Goodwill, they ain't selling for $1,000. Okay, so that's, even though the IRS says there's no guide, if you're ever audited, the IRS pulls out the Goodwill and the Salvation Army guide. So be prudent. It's not worth the blood, sweat, and tears if you're challenged on that. If you have a solicitation and you're not sure what it is, the IRS actually has a website, and it's called Exempt Organizations Select Check, and it's on the www.irs.gov. But if nothing else, documentation is the key. Documentation is the key in all tax work, but it's really the key in charitable, because if you don't have any support for that, I mean, I've had people lose they say, I put money in the basket every Sunday in church. No receipt, no deduction. So documentation is still paramount these days. We are date-driven people. Due to the pandemic, a lot of our dates got mixed up the last couple of years. So what we're showing you here is these are what, in a normal year, these are what the deadlines are. So March 15th is what we call pass-through entities. So partnerships and S corporations. That's because generally those organizations don't pay the tax. The tax gets paid by the people who are the owners of that. April 15th, then, is we have our individuals, our foreign reporting. Didn't really touch on foreign reporting, but if you've got a foreign bank account, or if you have a signature authority over a foreign bank account, you need to disclose that. The penalties on that are draconian. It is not worth it. So, I mean, there are a lot of people that they have they have an account in someplace overseas where they go on vacation just because it's easier. That's reportable. You're not taxed on it unless it's paying you interest, but it is a reportable event. And that's, when you see some of these high-flying cases, it's literally because they didn't report it. Some savings tips for small businesses. Qualified retirement plans. There are a lot of them out there. You want to pick the one that fits best for you. I mean, the advantage of them is, as the business, you get the deduction. As the employee, you get the tax-free growth, until they get to the age where they're required to make their minimum distributions, which right now is age 70. You also want to look at how you think your business is growing, because there are certain types of plans where they're limited for the number of employees you could have. And then, the contributions, if you're going to make contribution for yourself, they're what we call the top-heavy rules. So we can't set up a plan where the owners, we get this great deduction and the staff does not. So there are rules that everyone has to get a certain percentage. So they get complex, and there's some reporting on there, but the benefits of that, are myriad. And there are even deductions now. Actually, you can get a credit as a business if you set these up and you spend a certain amount of money educating your staff, your employees, on how the plan works. You get to deduct those costs, and some of those actually get a credit, not a deduction. You get a credit for up to half of those costs to set up the plan and to train your employees on that. So again, you get paid for doing good. So again, we talk about the American Rescue Plan in March of 2021. These employee retention credits, ERCs. We have done an incredible amount of work in these things. Basically, what the ERC, all these plans, the idea was to get money out into the economy. So the employee retention credit is just that. If you can prove you kept people on during the pandemic, despite your business going down, you get these credits. You get these reductions of your payroll taxes. With a lot of these things, of course, it is fabulously complex. But again, it is free money for having done what you could to keep your staff employed or keep your staff paid, during the pandemic. Sadly, with the infrastructure bill passing, that went away as of the third quarter of this year. But still, you can file retroactively for that. Same thing with the family and sick leave credits that runs through September of 2021. So again, if you can qualify under these rules and show a law diminution of business, you qualify for that. There's some small business SBA programs out there as well. One of the things that changed that affects regardless of the size of your business is, business meals for 21 and 22 are fully deductible by the business. Previously, it was 50%. So they're fully deductible as long as they're purchased from a serving place, a restaurant. So my 7-Eleven taquitos sadly don't apply for that. But if we go and get it delivered from somewhere else or go and pick it up, we get 100% deduction for that, and that's 21 and 22. PPP, the Payroll Protection Program. So that actually there's still dollars out there, but remember, if you didn't get forgiveness in 20, you take the forgiveness in 21, and that's assuming that you qualify and you meet all the tests. And basically, to qualify, you had to spend it on what you were supposed to spend it on. You had to spend it on rent, utilities, all the expenses, supplies to keep your business going. There was a very high-profile case recently where some guy was busted in Texas for buying cars and things like that. But it's pretty straightforward. And the idea, again, was to get money in the economy. If you use it for what you're supposed to, then you get the forgiveness on that. There are state issues there. The Commonwealth of Virginia only allows $100,000 of forgiveness. So, again, it's these federal and state differences you have to be wary of as you go through it.
Okay, Richard, with 15 minutes left, I'm going to launch the fourth poll. Please respond in the meeting screen or on the chat box.
All right.
And we'll close this up in 20 seconds. You can go ahead.
All right. I'm going to turn it over to Janice in about 90 seconds. Protect yourself from fraud. Depending on what your business is, know what you need to keep, know what you need to destroy. Phishing, we run these phishing tests regularly here. They're getting better and better. I mean, they can ape mimic your own firm's things, and as the business, obviously you don't want that exposure. But you also don't want the PR if, heaven forbid, something happens. And there's an IRS website on that as well. Build back better. And if there's one question I got asked more than anything else the last 6 months, what are the new rates are going to be? Nobody knows. And if they tell you they do, they don't. It's wide ranging. It's income tax. It's estate tax. It's all those things. When it comes out, we'll let you know. I mean, the one takeaway is the law is the law until it isn't. And you look at it and you say, complexity, there's a lot going on. There's a lot going on there. You sort of have to look at the basics of, how you're doing, what you're doing, to make sure that, the taxes aren't, the taxes are an ancillary to a profitable business. So the first thing is to make sure we're running our business as efficiently as properly as possible, and the taxes fall from that. So with that, I'm going to turn it over to Janice, who's going to tell us about getting ready for year end.
Thank you, Richard. As he mentioned, my name is Janice Wofford. I don't see the presentation anymore.
Just a moment, please. I will share it momentarily. All right, so let me just scroll to your slide.
Might be 37.
Okay.
All right.
All right. Yes. So my name is Janice Wofford. I'm representing the Client Accounting and Advisory Services team. Today we'll be discussing the benefits of getting your books ready for year end, preparing 2022 budgets, assess processes, procedures, preparing for 1099s, and any additional questions you may have. Why review your books for year end? Reviewing your books for year end gives you a chance to do some tax planning, review your asset purchases and disposals, and determine employee bonuses and owner distributions. It also gives you accurate information for decision making and gives you a chance to jumpstart year-end reports and tax preparations. What to review? Prior year financials. You want to make sure any adjusting journal entries made by your tax preparer has been properly recorded on your books. Accounts receivable. Determine what is still collectible versus uncollectible. Also, make sure that you have the current contact information for the person who's responsible for making those payments. Accounts payables, old items, duplicates. Let's review payments that may not have cleared the bank. Bank reconciliations, same thing. Look at those old outstanding checks. Take a look at some of your other accounts, your prepaid expenses, fixed assets. Let's gather those receipts for those purchases so that you can have them for your tax preparer. Accrued expenses and our deferred revenue accounts. Budgets. Now let's talk about budgets. You can work on preparing your 2022 budget. Some ways, if you have never did this process before, you could begin to look at and review your revenue and expenses that you had for this year as a baseline. Then move on to your 2022 financial and administrative goals and revise your budget based on that. Continue to revise your budget, modify until you have a budget that represents your goals for the upcoming year. Assess policies, procedures, and software. Look for ways within your processes for improvements and to have more efficiencies. More companies are moving towards having the ability to pay their bills outside of being in the office. So you want to look into a cloud-based billing system. Look into your internal controls. What is working well? What needs improvement? So 1099s. 1099s is one of the first reporting of the tax year. December is a great time to review your general ledger for potential 1099s. You want to verify that you have W-9 forms on file for your recipients because you have a small window of time to get them done and prepared and submitted on time. While there are several types of 1099 forms, the ones most relevant to most businesses are 1099 miscellaneous and 1099 NECs. The filing due dates for your 1099s are January 31st for IRS and recipient copies and 1099 miscellaneous for recipient copies. You have a little bit more time for your 1099 miscellaneous IRS copies. You have until February the 28th, but you want to make sure you get everything filed and on time because the penalties for late payments are pretty steep. The 1099 requirements, reporting of payments made in course of trade or businesses. You want to look at services performed by non-employees, if you gave any prizes, awards, any rent. Others including fishing boat crew members, royalties, suppliers of health and medical services, crop insurance proceeds, and gross proceeds paid to attorneys as part of a settlement agreement. Payments that do not have to be reported include payments to corporations, C Corps, S Corps, or LLCs taxed as C Corps or S Corps with some exceptions, payments for merchandises, telephone services, and similar, employee wages, because of course those do not get reported on 1099 forms, travel for tax-exempt organizations or government entities, and payments made by credit card companies. Those are reported on your 1099-K.
Okay, excuse me a moment, Janice. I'm going to launch the final poll of this webinar. It will appear on the meeting screen or in the chat box. It'll be open for about 20 seconds. You can continue.
Okay. Which 1099 forms? You have your 1099 NECs, the service performed by someone who is not your employee, including parts and materials if incidental to services, other non-employee payments, payments for services to an attorney or a law firm. All other reporting 1099s will be on your 1099 miscellaneous. Payments to corporations. Normally, payments to incorporated entities are not reported on Form 1099s. Exceptions, legal fees, payments to attorneys should be reported on Form 1099s, regardless of the law firm's business structure, and medical and health payments to physicians. Form W-9, we like to have, one of our best practices is to have every vendor fill out a Form W-9. The Form W-9 is a good tool to use because you will be able to have their information as far as their TIN numbers. They have to return with proper tax identification number, and it includes a checkbox for federal tax classes. Depending on their federal tax classes, a 1099 may not be required, but it's good to have it on file so you would know who you need to file these forms for. Our best practices, again, obtain that form from your vendors because like I mentioned earlier, the 1099s is one of the first filing reporting you're going to have to do at the beginning of the year, and it would be best not to be running around looking for federal identification numbers.
Okay, thank you for wrapping up, Janice.
Yes.
Before we get to questions, we've had a lot of content today, so you may have a lot of questions. Before we get to them, though, I'd like to thank everyone for participating today. What you'll see on the slide before you now are thumbnail images of 3 documents highlighting the expertise of the teams who presented today. And tomorrow what CBM will do is we'll send you electronic copies of these flyers along with the slides and a series of links that will allow you to sign up for 15-minute complimentary consultations with our presenters. You'll see Janice is not there. She is committed over the next several days, so you'll have a chance to sign up to speak with Dominic Belia, the lead for our outsourced division. And now we'd like to open the floor to your questions. So please use the chat box and our presenters will be happy to respond.
Thank you, Joe. So yes, please type your questions in the chat box. We will read them out loud, but we will not mention your name for privacy purposes. So please feel free to do so. We actually had several questions that were submitted to us in advance, and some of them are good and some are actually very good. So I'll start with one here. How should we handle PPP forgiveness if we filed for it but haven't received the approval yet? What do you think, Richard?
If you filed and haven't received approval for it yet, I'm going to assume your calendar year, your year's not over. Generally, it doesn't take them too long to do it. So in theory, you have until March or April of next year to file. So you should get it. Again, they're not arbitrary on this. If you meet the mechanical test to it, you qualify. So we had a lot of people, and there was a position to take last year, which was if you think you're going to get it, you could treat it as forgiven in 2020. So so I would say your choices are 20 or 21. So if you didn't take it in 20, you want to take it in 21.
Thank you, Richard. Here's I guess a similar question. Recent bill passage eliminated. Actually, no, it's not similar. My apologies. Recent bill passage eliminated Q4 ERC. Is this official, and any possibility Congress reinstates the ERC beyond 2021?
It is totally official, and I have no idea what Congress is going to do going forward. I mean, their economic indicators that Alex is showing are showing growth and activity. So, but my crystal ball is as useless as anybody else's. But one would think, given where things are, no, it wouldn't be extended past September 30.
Thank you, Richard. And we actually have a couple of questions from the chat box. So I'll start with one. If you have a 401k and then have another company that has a SEP, what is the total that you can put into each account? Would you like me to handle this one, Richard, or do you want to?
Go ahead.
Yeah, so the answer to that question, in terms of your 401k, and I'm assuming it's an employer-sponsored 401k, you can contribute up to the annual limit, which is $19,500 this year. They actually bumped it up to $20,500 for next year. If you're over the age of 50, you can also contribute an additional $6,000 catch-up contribution. For SEP IRA accounts, the calculation is different. Into your SEP IRA account, you can contribute approximately 25% of your net income. So that would be in addition to your 401k contribution. I hope that answers your question. Richard, do you have anything to add?
Well, I mean, there are limits because they sort of have to be coordinated so that you can't, in theory, you can't jump from job to job and max them all out on that. So it gets complicated, but yes, that's the global answer on that.
Well, to actually follow up on that, I got that question in the past. If you have multiple 401ks, so to make it clear, it's $19,500 per year overall. If you have 3 401ks, unfortunately, you cannot contribute $19,500 into each. So that's a good way of clarifying it. There's another one. Is American Rescue Plan income taxable? Richard, I guess this one is for you.
So there's really no income from it. So that's where we try to get a little more explicit with the terminology. Usually they're credits. So they're advanced credits. And that's where people got in trouble last year. Like, hey, free money. But when they say advanced rebate, it's a fancy way of saying, well, you were getting your overpayment that you were going to get in April. You were getting it last year. So that's where when I talked about people had some unfortunate results. Because they'd already gotten their refund back courtesy of the federal government. So it is not taxable per se. It's it's a prepayment of your own refund, if that makes sense.
Thank you, Richard. Here's another one. Is there any limit on the amount that you can contribute to a 529 plan? Is the amount contributed deductible? So I'm happy to.
They're teeing it up for you. There you go.
That is my bread and butter. So in each state, well, I'll talk specifically about DC, Virginia, and Maryland. You have an annual deductible amount. In Maryland, it's $2,500 per person per year. In DC, it's $4,000 per person, or $8,000 if you're filing a joint tax return. And in Virginia, it's $4,000 per person per year. So there are two types of limits when you're trying to contribute into a 529 plan. The first one is your annual gift tax exemption, which is currently $15,000. So if you decide to contribute more, you're free to do so, but there's a possibility that you would need to file a gift tax return unless you elect a 5-year averaging strategy, which is actually a very popular choice. It would allow you to contribute essentially 5 years of your annual exclusion, and then basically not reduce your lifetime exemption. The overall limit for most plans is a little more than $500,000. If I'm not mistaken, for Maryland, it's like $520,000. And to add to that, actually, the 529 college savings plans, they're a very versatile tool, of course, for college planning, but also for estate planning purposes. When you make a contribution and it stays there and you remain alive for at least 2 years, it actually no longer part of your estate. So I'll add that point as well. Anything to add, Richard?
No, I mean to your point, most of it's a gift. Very little of it gets you a deduction.
That's right. So the next one is, I guess, conceptual. Let's call it a conceptual question. What is your projection on the Evergrande default on U.S. markets and timing of such? So that was, I guess, Richard, I'll jump into that. That was a popular discussion topic, 2 or 3 months ago at this point. And for those who are less familiar, the comparison was, is that the Chinese version of Lehman Brothers, or is this just essentially the tip of the iceberg, so to speak? Based on the information I have, and based on the recency or the frequency, I should say, of the updates, they're no longer all that frequent. My understanding is that situation will be handled by the Chinese government. I have two comments to make. The first one is that in China, you cannot go bankrupt. Anytime the government wants to put you on ice, they can essentially do that anytime. And the second comment is what's been happening with Evergrande and other similar situations. They can stop making internal payments because essentially they would be making them to themselves, because in China, their banks do most of the lending, not necessarily private institutions, but they would continue making them to investors outside of China. As we speak today, I do not believe this will result in any global issue. But in China specifically, I'm sure it's going to be a problem.
Alex, I'm going to interject for a quick minute just to thank everyone for coming. We are at the 75-minute mark. If there are questions that we continue to receive and the presenters are fine with it, we can keep going. But as a courtesy to those of you who signed on for 75 minutes, thank you for joining us.
All right. So should we take a couple more, Richard? What do you think?
Yeah, let's take a couple more. Actually, on that, while you're queuing it up, I was virtually attending a national real estate taxation conference yesterday, and that specific question came up about China and what the effects are going to be on the U.S. So it's interesting that it's sort of circling back around into in the popular sphere at that point. So.
Well, it was major. I remember reading about it the first time, and I'm pretty sure that was the title of the article. Is this the tip of the iceberg? I mean, because that's the issue. That was one of those times when I, again, heard the term default swaps, right? I mean, no one talks about that anymore, but that's the issue. It's not so much Evergrande, which is, the second largest real estate developer in China, which is large by itself, but it's all of those financial instruments that are involved. So a couple more questions here. What is the capital gains outlook for 2022? What do you think, Richard?
Oh, on the rates? Who knows? I mean, you wouldn't have thought that this Congress would extend the SALT, would increase the SALT tax deduction. So, the longer it goes on, just from what I've seen, the longer it goes on, the harder it is to do sweeping bills. So if you look back historically, whether it was, George W. Bush, Bill Clinton, Ronald Reagan, and if you don't get that done in the first year, it's hard to do. So, our basic thing is, look, the law is the law until it isn't. And we have a lot of people, clients and non-clients, and I'm sure Alex saw it too, who did things at the end of 2020, because once they saw the election, and this is regardless of political affiliation, so I'm not making a political statement. People on both sides of it said, well, I know things are going to change, so I'm willing to do X. Okay. So I don't know. I don't know what the popular wisdom is on what those rates are going to do.
Fair enough. Well, and I guess the final one, the most challenging question, I guess, of the day, how can I lower my tax bill? What are your thoughts on that, Richard?
Yeah. After what are the rates going to be? I mean, it goes to sort of the fundamental structures. It's how you set up your business. I mean, some of those things. I mean, some of the nerdy business law stuff you learn in college. I mean, literally the structure you use, whether you choose a corporation or a partnership or a trust or something else, it matters. I mean, and sometimes it's some fundamental aspects that do it. But there's no magic bullet out there. There's nothing that quote unquote the smart people are doing. There are ways to arrange things, and we talked about certain types of retirement plans and things like that. There are things you can do. There are ways you can reduce your estate tax by an easy one, 529 plans for your grandchildren. You can do what Elon Musk does. You can move to a state with lower taxes. I mean, there are a lot of things you can do, but understand that it's the taxes are the classic bell curve. Okay. We can talk about people on the edges. It's the people in the middle, and a lot of people in the call are on some part of this middle. And so it takes a comprehensive look at how you're structured and what your sources of income are and things like that. And that's why we talk about different things like Roth conversions or donor advised funds. And there are avenues, but none of it is easy or straightforward.
Agreed. The only thing I would add is careful planning. That would certainly help with lowering your tax bill.
Planning and documentation. I mean, two things we talked through the slide deck.
All right. Well, I guess let's finish here. Of course, if anyone has any other questions, our contact information is on the slide in front of you. Joe will distribute the slide deck to you shortly. I believe we usually do it the day after our webinars. So yes, if you enjoyed it, then feel free to reach out to us anytime.
Have a great afternoon, everybody. Thank you.
Have a great afternoon.